Hey, what's up, everybody? My name is Sureshni Ryder, and welcome to another session of Study Sesh brought to you proudly by Boston Broadcast. Today, we get back into accounting, and we're catching up once again with Esna de Kock, who is our lecturer in financial accounting. Hey, Esna, what's up? How you doing?
Hi, I'm good, thanks.
Esna, I saw the topic for today, and immediately I thought of PPE because I thought about COVID. And I thought, remember during the time of COVID, we all were given this term PPE. But I don't think PPE has anything to do with COVID, but rather PPE, we're discussing property, plant, and equipment. What is this? What is PPE?
Okay, so PPE is definitely not COVID related. In accounting, PPE stands for property, plants, and equipment. So it's property, buildings, land, it's the machines that you use to manufacture something, and even your office chair would fall under property, plant, and equipment.
Got it. And if we remember our first session, the example that we've used as our golden thread, of course, was owning the sneaker factory. So in this particular case, it's the sneaker factory that's the property and the plant and what we're trying to create or what we're using to make these sneakers, correct?
Yes, so when you use the sneaker factory, for example, your property, plant, and equipment would be if you own the building where you manufacture your sneakers, the machines you use to manufacture your sneakers, all of those assets that you have would you classify under property, plant, and equipment.
So Esna, now that we've established what the definition of PPE is, I want to know what characteristic do these assets need to have in order to be classified as a PPE?
To be classified as property, plant, and equipment, you would need to meet the definition criteria of an asset firstly, and it should be a physical asset. So you would need to be able to physically touch the asset, physically touch the laptop, physically touch the machine that you want to classify as PPE. You take, for example, you want to buy a machine for your sneaker factory that manufactures the shoes. So, in order for you to be able to classify that, you need to be able to physically touch the machine. So, you can touch your machine, so it meets the physical touch definition. And it should be used in the production of income. So, you need to use that machine to produce something that you can either sell, or if you're in a service related entity, that you need to use the machine to provide the service. And then also you need to be able to use that machine or your equipment or land for more than 1 year in order for it to be classified as property, plant, and equipment.
So, Esna, we figured out the characteristics for these assets then to be classified as PPE, but how do I determine the amount that I capitalize to those things?
Okay, so the amount that you capitalize to your PPE, we are still on using the machine example. If you have the machine, it's not just what you pay for the machine. You can also capitalize the delivery fee, the installation of this machine. So everything that you pay to get your asset in the place and position to use it that you intend to use it for. All those, the delivery, the installation, all of those costs, you can capitalize to your cost of your machine and your PPE then.
Okay, so if I were to use a practical example, because we're talking about the sneaker factory, let's say I have something that helps me place the sole of the shoe into the shoe itself, right? Let's say it's a special press machine that we use. I ordered it off Amazon or I ordered it off Takealot, then I basically put the cost for what it would cost me in terms of my taxes. Then I used a friend to come through and deliver it because it was quite a big machine and I used his services. So whatever his delivery charges, I write that down. If I unpacked it because I'm not a professional unpacking, I brought in a laborer that was able to do that for me and actually set it up. And I used like a professional to help me set it up. Then that's a cost as well. Is that basically where we're going with it?
Yes, definitely. So you have your cost of your machine, the delivery to get the machine where you want the machine to be, where you want to use the machine, as well as all the expenses that you have to get the machine in a working condition for the intent that you have for the machine.
So I think a nice thing to say there is basically you are the business owner. You need to recognize all of the different touch points, everybody that gets to touch this particular machine before you go out and actually manufacture the final product. I think once you know where you started and the end product and the little people in between that helped you get there, and recognizing and accounting for each of the costs, that basically helps us capitalize perfectly.
Yes, exactly.
So Esna, now that my factory is doing really well, obviously some of my equipment is going to get outdated and maybe there's some new high-tech things coming my way, which I really, really would like. My machine is outdated. I definitely don't want it. And now I want to dispose of it. What happens next?
Okay, so in your accounting system, you would still have your machine at your cost. You would have your depreciation that you had while using the machine. Now you want to sell it. So now you need to de-recognize the cost of the initial machine. So you're going to remove the cost of the machine, but now you sell the machine. So either you can make a profit by selling this machine, or you would make a loss by selling this machine. So let's say, for example, you bought this machine for 5,000 Rand. You've been using this machine for 2-3 years, and now you decide, I don't want to use this machine anymore. But there's somebody out there that really wants this machine, and they see value of 6,000 Rand in this machine. And you sell that machine for 6,000 now, then you can actually make a profit, and you also need to account for that profit. On the other hand, you can make a loss on the machine, so you can dispose of this machine for less than what the carrying value in your current financial statements are, and then you have to account for that loss as well. So you remove the asset from your asset register, and then you must account for the profit or the loss from selling this machine.
So Esna and I have been trying to unpack three things: property, plant, and equipment. And I think a way to wrap it up for my section is to say that I think PPE is such a crucial part when it comes to understanding a company's assets. It also is so essential to know what PPE is in the first place before you start the business, while you are in the business, and the possibility of you closing up business. What do you think, Esna?
Yes, definitely. It's very important to understand the terms and the recognition criteria, as well as how to account for PPE, because it could be a very big asset in your financial statements, and also to account for it correctly, to know what you can capitalize and how to depreciate it, and how to account for when you do intend to sell those assets.
I love how you unpack each of the pillars. I think I'm very inspired to open up a little sneaker factory. I might need you and the students to help me with accounting. Thank you so much, Esna, for being with us in another episode today of #StudySesh, brought to you proudly by Boston Broadcasts.